Good morning, everyone. So today we are going to do bonds, right? Okay. So last class we had done accounting treatment for investment in equity securities, right? And today our topic of discussion will be bonds. Bonds basically it's a borrowing agreement. Okay. Last class. When we did investment accounting, we did from the investor's point of view, right? And today we are going to study bonds. So this will be from company's point of view, from the company's point of view, right? Now, as we know that while we have done investment accounting, we had only covered investment in equity securities, right? We haven't covered investment in debt securities yet. So before studying investment in debt securities, which is from the investor's point of view, we need to first cover bonds. That is the company's point of view, the person who issues the bond, or rather the person who borrows the money, right? So basically, if company is issuing bond, it means it's a source of finance for the company. So basically, it's a borrowing agreement in which investor lends money to the company and company who is the borrower promises to repay a certain sum of money certain amount of money after a certain period of time, right? Basically, I am using bonds as a source of finance. Basically, it's a borrowing agreement, like we take loan from bank. In the similar manner, bonds are issued to the investors, and against that money is raised, right? So whatever treatment we are going to learn today, we are going to do it from the investors, from the investee's point of view, not from the investor's point of view. Once we have covered from the company's point of view, it will be easier for us to understand accounting treatment for investment in debt securities, right? So that's why we have first doing this bond part from the company's point of view, and then we will go to the investor section, that is investment in debt securities, right? So borrowing, it's a borrowing agreement in which the investor lends money to the company. So we are doing accounting treatment for company, right? And the company who is the borrower promises to pay certain amount of money after a certain period of time to the lender. Now who is the lender? Lender is the investor, right? And also promises to pay interest, right? So this is a borrowing agreement is all about. One person lends money to another. The other person who is borrowing, that is the company, promises to return the money, repay back after a certain period of time, say 4 years, 5 years down the line, and every year I will be paying interest. Promises to pay interest every year at a stated rate. This rate of interest is already pre-decided in the borrowing agreement, right? This is already pre-decided in the borrowing agreement, right? Okay. Usually when we take loan, right, so the simple accounting entry is when loan is taken from bank. So the simple accounting entry is cash debit. It's loan from bank credit. Suppose say $1 lakh. Right? And this loan is a liability for the company, rather the borrower. Right? So this liability will be repaid after a certain period of time, say 5 years, and every year I have to pay interest. So every year interest to be paid to the lender. Suppose at the rate 10% per annum. Right? We are just moving slowly. So now the amount of interest which will be paying is $1 lakh into 10%, that is $10,000. So the normal accounting entry is interest is an expense for you, right? That's debit. It's $10,000, and there will be outflow of cash. Right? So this will be at Y0. This will be at Y0. This will be at Y1 to Y5. Every year I will be paying interest. Now what will happen? After 5 years, loan is repaid. Very simple. Loan from bank debit, cash will be credit. So it is $1 lakh. Now this is a normal accounting entry we do when we take a loan from a bank. Similar type of entries we will do when the company is issuing bond. Now these bonds are traded in the market, right? If I take a loan from a bank, that is not publicly traded. But if I issue bonds just like shares, in case of shares, the investor gets a ownership rights into the company, right? Now, when I am issuing bonds, it is a borrowing agreement. The lender does not get any ownership rights. The lender is promised that he will get a certain sum of money after so many years, and every year he will get interest, right? So whenever any instrument is traded in the market, so you have to connect that instrument with the market rate of return, right? So when I am connecting any instrument with the market rate, there might be a situation, see the amount of interest which I am giving to the lender is less than the market rate, is more than the market rate, or at par with the market rate, right? If I am meeting the expectation of the investor, if I am meeting the expectation of investor, it means the amount of interest stated in the bond exactly matches with the market rate. If I am not meeting the expectation of the investor, it means the amount of interest stated in the bond is less than what the market is giving, right? And if the investors are over satisfied, over happiness, then in that case the amount of interest stated in the bond is way more than the market rate, right? So whenever any instrument is traded in the public, like stock exchange, in India we have NSE, BSE. India may basically the bond market is not that developed, but in US the bond market is very actively traded, right? Bonds are very actively traded in the US market. So we need to establish a nexus of bond with the market, right? So when you do that, so if the bond stated interest rate is at par with the market rate, then the bonds will be trading at par. There won't be any difference in the price of the bond. Suppose the unit value of each bond, just like share, the unit in case of share it is $10 or $1 or $5, but in case of bond it is say $100 for 1 unit. So if the stated rate in the bond is with the market, it means the bond will be trading at par in the market, right? So let me just try to establish some connection of bond with the market. Bonds are publicly traded in the US market. So I'm trying to find out some connection of bond with the market rate. Establishing relation oblique connection of bond price with the market rate of return, right? Actively traded. Just like in India we have a huge market for the stocks, in US you have huge market for the bonds as well, right? So bonds are publicly traded in the US market, establishing some relation or connection of bond price with the market rate, right? And accordingly its accounting treatment will be underlined, because if I see Indian accounting standard, more or less they focus on historical cost accounting, but if I see US GAAP, they are more inclined towards the present values, fair values, market values, right? So then they always try to show financial items, assets and liabilities at fair values or at market values, or it must have some connection with the market rate, right? So let us find out some connection, then accordingly we will do the accounting treatment. If stated interest rate in the bond issued is at par with the market rate. What is market rate? Market rate is the rate which the every investor is earning in the market. If I am investing in bond market, right? And this is quite natural, this is bound to happen because suppose today I am issuing a bond and I told ki 8% interest I am going to give. Now economy doesn't remain constant, it changes maybe due to inflation, whatever may be the factor. So interest rate is bound to change in future, but I have already stated the rate of interest in the bond and it's a fixed bond, fixed rate of interest bond. So in that case the bond price will fluctuate in future, so accordingly it's accounting treatment, right? So if stated interest rate in the bond is if the stated interest rate in the bond issued is at par with the market rate, then the bond will be trading at par, right? It means the bond is meeting the expectation, the bond is meeting the expectation of the investors. Satisfied if stated interest rate in the bond issued is less than the market rate, right? Market, the rate of interest is going 8.5%, but the bond which I have is giving me only 6%. Then in that case I may not be willing to pay for the bonds, right? So in that case the bonds will be trading at below par, means at discount. Then the bond will be trading below par, that is at discount. The bond is not meeting the expectation of the investors, less satisfied. What if stated interest rate in the bond issued is more than the market rate? Market rate is 5%, 6%, but I am giving 8%. Then the bond will be trading above par, that is at premium. Overwhelmed. More satisfied. So given the situation, its accounting treatment will be done accordingly. I guess this is absolutely fine with all of you. Okay. So if I am paying at par with the market, no problem. Bonds will be trading at par, so I will issue bond at par. See, if you are not with the market, if you are not with the market, then in that case no one will subscribe your bond. Then you won't be able to raise finance, right? So if your stated interest rate is at par with the market rate, no problem. You can issue your bond at par, right? So if I am issuing a bond at par, suppose I issued 1 lakh bond. Journal entry for issue of bond at par. So this is cash debit. This is bond payable. Simple. Right? Now, this is simple. Bond issued, like we have taken loan from the bank. Cash to loan from bank, liability. Out here it will be cash to bonds payable, liability. Right? Now, if the bonds are issued at discount, because I have to be at with the market. So if I have to be with the market, then I have to issue my bonds at discount. No option. Because I am paying less what the market is earning, what the investors are getting from the market. But in this particular situation, if I issue my bonds at par or more than at par, who will subscribe? Are you ready to subscribe for it? No, you are not ready to subscribe for it, because this bond is not meeting the expectation of the investor. The investor wants 8 to 9% return, whereas you are giving only 6% return. Why would I subscribe for it? Is my money is for free? No, money has time value, opportunity cost. Journal entry for issue of bond at discount. So if I have to issue my bonds at discount, then cash debit. Say for example, I got $78,000. The discount calculation I will explain you, don't worries. Discount on issue. So if 1 lakh ka bond I am issuing at 78,000, so 22,000 is discount. This bond payable is liability. So cash debit 78,000, discount on issue 22,000, right? Now if I am issuing my bonds at premium, because in this particular situation, when I am giving more than the market rate, it means I can charge them. I don't have to make them overwhelmed, over satisfied. I can encash that situation. So in this case, I will ask them more. Now, how much more, that I will, that calculation I will show you. Suppose it is 1,19,000. However, my bond liability is how much? One lakh. Difference is premium on issue. I think this is absolutely fine with all of you. Now, why companies issue bond at discount? Why companies issue bond at premium, sometimes at par? It purely depends upon what you are giving and what the market is giving to the investors. If you are giving less than the market, you have to issue discount. You have to issue bonds at discount. If you are giving more than the market, you can encash that moment and you can issue your bonds at premium. You can get more collection.